All right, thanks for turning up so early in the morning. I know most of you have a very late Saturday night. I'd like to get to know a little bit about my audience. Probably you guys are all young, look very young. Young defined as less than 70 years old. In Japan, if you're in Okinawa, you're deemed as a teenager. You know, they call it you're a spring chicken in Japan. So we've got a young audience over here, raring to go, trying to look to understand a little bit about the markets in general. I'd like to see, by show of hands, how many of you are actually investors looking for or have reinvested or looking to buy a property outside Singapore? By show of hands, just roughly. All right. And how many of you have already are looking actually into markets like Malaysia, for instance? Malaysia? Invested or looking? Couple of hands. And how many of you are looking into Japan, for instance? Japan? Anyone? Looking? Invested? None? How many of you looking into the UK, particularly into London? We've got a few hands also. I'm going to tailor-make my presentation in accordance to the hands I have. Looking into Australia, for instance. Australia, a few hands over here. Great. A little bit more hands, in fact. What about in markets like in US? US? Anyone? We've got same hands looking global. Very good. Excellent. Any other markets outside these major cities that we talk about? Thailand, Laos, Cambodia, Indonesia. All right, fantastic. Well, let me see if I've got. I don't think I've covered Indonesia here, but we can actually definitely discuss some of the points later on during the question and answer sessions. Yeah. All right. I've got roughly about half an hour, which means I've got basically less than 25 minutes right now. I'm going to run through basically a few points important on the outline basis. We're going to talk about global markets. What has changed in the last 12 months? Look at economic indicators, which is so important these days because the economic indicators will depend very much on government stimulus measures, whether they're going to tighten or they're going to roll back. That affects your currency because when you invest abroad, you got to look at where currency is moving. And importantly, interest rates. These days, movements in currencies and interest rates depend very much on the political policies, the monetary policies that are introduced by the government. Then we're going to talk about why Singaporeans are investing abroad. Look at generally some of the hotspots as mentioned, Malaysia, very quickly, because Siva, my keynote speaker, is also going to talk very much in detail on Malaysian market. Talk a little bit about Tokyo, Japan. US, we're going to cover New York, LA, San Francisco, Australia, Sydney, Melbourne. We talk about UK and London. So we're going to go through the globe to talk about where the market is and some of Chesterton's international top picks. I'm going to do a summary. And then things to look out for in 2015, 2016. And lastly, investment tips. Now, I was here last year talking about the same market last year. Then we had a slightly different market environment. What has changed in the last 12 months since I was here 12 months ago? If you're looking into domestic front, residential property prices have actually moderated in Singapore, which is one of the lure people are looking into investing elsewhere for Singaporeans. Sing STI regional bosses are now at record high. Sing is at record high right now. Hong Kong is record high. The US is nearing a record high. Some of the Frankfurt stock bosses are also at the record high right now. Foreign property sales activity, which is being launched over here, has moderated slightly. We have got a threat of interest rate with SIBOR crossing 1%. That was about a few weeks ago. But recently, last couple of days, it started to dip below 1%. So, but the threat of high interest rates is going to affect decision-making process by investors like yourself looking into buying into markets in particular. Internationally, 12 months ago, what we saw, crude oil commodity prices sank to the lowest level. It affects a lot of emerging markets. It used to be a buy call to enter into markets like Brazil, for instance. But because commodity market has actually seen prices dipping to the lowest level in recent years, that has an impact on property markets in those countries as well. Sing currency continue to be to gain strength against major basket of currencies, except for the US, where it's lost some grounds in the last few months. Economic, political uncertainty in Greece, Russia, terror threats in Middle East, all these impact decision-making process. In fact, there was a terror plot just been announced in Melbourne just yesterday. And look at your key economies, in particular, markets like Eurozone, like your Australia, China, Malaysia, they're all implementing continued loosening of monetary policies. In particular, while there's a threat of interest rates, especially in Singapore and US, because our interest rates is tied onto US interest rates, a lot of some of the markets like Eurozone, Australia, China, Malaysia have actually loosened their interest rate, the central bank interest rates, which basically is a dichotomy where we've got threat of interest rates in some markets and then some loosening of interest rates in some other markets in that sense. At the same time, some domestic markets are coming up with high-tiered tax regimes targeted for foreigners. For instance, Australia have introduced application fees, 5,000, 10,000, depending on the properties that you're buying. And then Indonesia is proposing a luxury tax, which basically covers everything from 150,000 USD and above. Malaysia have already introduced capital gains tax with effect from April last year. You've got UK implementing capital gains tax this year. You've got Labour government saying that, you know, if they win, they're going to introduce mansion tax, which is above £2 million and above. So a lot of things to consider, a lot of decision-making process when you look into buying portfolios and evaluate strategies. Now, the first thing you've got to look at in buying any property is to look at your economic indicators. And that is basically one way to stay ahead of the market. It's not too difficult to see whether a country is actually ahead of the market by virtue of looking at GDP. For instance, if above positive, if you're looking into above positive grounds, then there's a possibility that there could be potential tightening in some of these geographic, i.e. interest rates moving upwards. Where some markets you see, like Japan, for instance, have actually started to dip downwards where it entered into a deflation. Then you have stimulus measures coming up, just as what we saw in 2012. 3 trillion yen being printed out as stimulus measures, and that will contain a low interest rate environment for that particular market. So look at where economic growths are going. In some cases, high economic growth may not necessarily mean good news for the country. China last year did 7% yield, 7% economic growth, but that's not good enough to sustain a market that is typically used to 8 to 10% growth. And because of that, they started to relax some of the measures. They even brought down their interest rates. So keep an eye on GDP growth as your first precursor to know whether interest rates likely to be tightened. Because whenever interest rates goes up, your currency is likely to, value will go up in that particular country. And the reverse happens as well. Any downtrend in terms of interest rates, your currency will come down. Similar as what we saw in markets like, for instance, in Australia, where the RBA has reduced interest rates to 2.25% at record low. Take a look at inflation. These days, the threat of inflation is not as clear. Why? Because oil prices have come down, commodities have come down. Now you've got a problem of deflation. That's what you're experiencing in Europe. And as a result, the Central Bank of Europe have actually reduced to their interest rates to a low level. Take a look at markets, the employment rate. Employment rates are also important because in places like US, the key to increase interest rate is by virtue of employment rate hitting 6%. That's a magic number. And that's what's triggering the upside in terms of interest rates computation in US that will affect Singapore as well. If you look at the momentum snapshot, you might not be able to see this. Anyone needs a slide of this, at the end of my presentation, I've got my email address. Just drop me a line. I will be more than happy to provide you some of these slides. Take a look at momentum snapshots here, where if you're looking at, this is all your countries that I've actually highlighted. You've got the demand growth parameter, supply growth, you've got rents, you've got transaction volume, and you've got your asset values. It is good to have high increasing demand for growth for demand. It's good to have stabilized or reduced supply. It is good to have rental moving upwards, important, because that's what's going to ensure that foreign buyers, if you were to buy property, you can rent out very easily. It's important to have strong transaction values. Why? Because you need a liquid market. When you enter a market, you want to exit, there are people looking to buy. And then you want basically a market where there's going to be consistent increase in asset value, at least that covers your inflation rate. So if you look at some of the markets over here, like for instance, US, you've got high growth in demand, high growth for supply as well, lots of building, but rents is moving up, that's supporting the market in total. That's your fundamental support that you're looking at. And then you've got generally, transaction volume has remained fairly much the same. UK is interesting, you've got demand drivers up, you've got basically supply fairly stable, and you've got rentals moving upwards, high transaction volume. Singapore is just the reverse. You've got low demand, and you've got high supply. Rents, in fact, is coming down. This is research based on Morgan Stanley's report. And we've got transaction volumes dipping as well. Australia is interesting, where you're seeing generally stable demand, stable supply growth. Rents in some market remain stable, but you've got certain markets, rentals starting to dip downwards as well. Now, why is Singaporeans generally, we've seen Singaporeans being one of the top overseas investors for foreign properties. Why is that so? Interestingly, this is based on the MAS report, is the fact that our net household income has actually, net wealth actually increased in the last 4 or 5 years already. And if you look at generally our asset base for household assets, we have that household assets represented in blue, property, that has actually started to taper off because residential properties have started to come down slightly. But if you look at the red portion here, this is your savings. This is your savings portion, and that component has started to increase over the years. And when you have got an environment which is low interest rate, money needs to be kept in higher yields, yielding assets. That's where a lot of investors are starting to look and put money into currencies or putting money into foreign properties, yielding hopefully higher returns. Overall, you've got overseas property transactions by Singaporean hit the peak at about almost 1.6 billion in 2013, first half, but it started to taper off in second half in 2013 and first half of 2014. This is from MAS survey of property transactions. Why? Because of your TDSR that was implemented in June 2013. Now we look at Malaysia very quickly. We've got the ringgit softened by about 15% on a year, in the last 2 years. I've used a window of about 2 years because some people have bought properties in 2 years. Then you can see where you're making in terms of your capital appreciation. In some cases, you might be facing currency devaluation in that sense if you are to activate a sell now. Majority in Malaysia is mainly a market which is close to Singaporeans. If you look at most of the investment flows, we've got Chinese developers have started to come into the picture already, which is interesting. Particularly, they have actually entered into the Iskandar market. I'm going to just look at the opportunity. Generally, we see supply is a major concern in Malaysia. In particular, Iskandar is a major concern as well. And the whole market has been affected by the government measures in budget 2013 in October. And we have seen some capital gains that has actually transpired, tax that has transpired in the market since last year. Now, if you look at transaction-wise, there's been a steep drop in property values in Johor. Johor is represented in red. We've got a steep drop in terms of quarter to quarter, about 33% in Johor, compared to markets like in Selangor, which is 2%, up on a quarter to quarter. Kuala Lumpur is negative 12%, and Penang is about 8%. In total, Malaysia is about negative 7%. This is computing all property transaction values. And this is by CEIC, which is an independent economist research owned by, I think, Euromoney, which is used by a lot of central banks in the world. if you look at the price house index, surprisingly, while there's, despite a drop in transaction value, Johor house price index actually slipped only by about 1% in the fourth quarter of 2014. On a year-to-year basis, prices in Johor and Penang had outperformed national average increase. On a year-to-year basis, if you look at national average, it's about 7%. It's up, but Johor has actually gone up by about 10.8%, and your Penang has actually gone up by about 8%. So what we've seen is that there's been a huge drop in transaction volume, especially in Johor. Your prices have dipped slightly on a year-to-year, on a quarter-to-quarter basis. The interesting part is that the market generally in KL, Klang Valley market has been very stable. Penang has been quite a stable market as well overall. There has been a transaction, there's a shift of mindset for investors moving in from residential commercial properties, for instance in Skandar, into industrial properties. In fact, you look at the performance of residential commercial, it has come down on a quarter-to-quarter basis by about 42 and 43%. But industrial generally have come down by about 4%. I think the impact has been well supported for industrial by SME companies from Singapore that's looking into buying industrial properties, relocating because of the tightening labor costs in Singapore and high costs in terms of rental. A lot of companies have started to look into Malaysia as a potential. Just recently, Telecoms Malaysia is moving their data center into Nusa Jaya Tech Park. There's been one of the major drivers of tenants, corporate tenants that's moving in. And some news on Singapore companies have also moved into KL, into Johor Bahru. Japan, yen has actually weakened by about 17% in the last 2 years, mainly because of Abenomics. Abenomics seems to be fundamentally what's creating the optimism for investors to come back into the marketplace. Low borrowing cost is also a major pro for investors to come in. What we've seen is that the 2020 Olympics is one of the main drivers as well for investors. So you look at generally the people who are looking into Japan, the good news is that your yields can be about 3 to about 6%. If you're looking into prime Tokyo, Tokyo is a main area for investors to target upon. Investors from Singapore love hotels. They're looking into office buildings, for instance. We've got an order from our Singapore high net worth and investors looking just purely 20, 30 million office buildings. And there are not many stocks available because the local REITs in Japan is looking to buy. A lot of funds from Europe is looking to buy as well. Then you've got the Taiwanese, Hong Kongers, even Chinese companies are looking into buying into Japan. Primarily, first stop would be Tokyo. Second stop would be the next biggest city, which is Osaka. The residential market seemed to have actually moved up. Why? Because strong demand coming from investors. Not only locals are also starting to buy because of Abenomics, ease to get financing. And Japanese have not been so bought into home ownership yet. Now the trend is starting to come in. So I think Japan looks pretty interesting as a market. We think that's going to be capital values is likely to rise. It has risen by roughly about 8% last year. We think it'll probably rise by about another 5% this year. Rentals is still very strong. So any market you go, check on the rental market, the ability for it to lease. I'm going to go through very quickly because I don't think I can finish 56 slides over here. Just take note that the market actually peaked in the 2000s, and then it went in the late 1990s, and then it went into what we call a zombie period, deflation, no action. Banks don't want to lend money. People keep money in the bank, no activity. As a result, Abenomics is meant to lure investors to start, the locals, Japanese, to start investing. And they want to make sure that the economy sees an inflation effect. They don't want to get into deflation. The economy went into deflation in third quarter of last year, technical recession. So a second round of stimulus measures were introduced by the government during the fourth quarter of last year. Take note that residential prices and land has actually started to go in. Why? Because a lot of developers are now starting to enter into the residential market, in particular Tokyo. In the last 2 years, we've seen growth in land prices alone, which will see positive spillover effect in terms of end unit prices. These are some of the monthly rents fairly stable. When you talk about Japan, don't expect prices to move ups and down, not like a Singapore market or a Hong Kong. Things tend to move pretty much on a moderated level. If it goes up, moderate, 5% up in that sense. Gross yield have come down. In Tokyo, what used to be 6% is probably about 5% right now. On a net basis, you're going to deduct 1.5 percentage out of that. So your net yield could be anything from 3.5 to about 4.5%. Why? Because generally there are more buyers coming into the market, and prices have gone up. And price movement have moved faster than the rental levels in that sense. Generally, foreigners are still keen in Japan. We've seen generally a whole slew of portfolio, especially led by foreign funds. Singapore companies have started to buy in. CDL Hospitality REIT has started to buy into hotels. Parkway REIT has continued to buy medical centers. You've got city developments entering into buying Seiko's main residential housing land parcel. So a lot of diversification of developers from Singapore entering into the market. And I think a lot of these developers will, when they get their planning approval, will start to bring projects into Singapore and start to market it. So it's got a compelling story. It'll most likely feature in our top 3 destinations in Singapore for Singaporeans to invest. Now, in United States, it's a bit far off. I don't think I saw any hands, maybe 1 or 2 hands for US. So if you look at the currency, it's actually gone up by about 10% in terms of currency strength. One of the few currencies that has basically saw an improvement, appreciation over the Sing dollars. One of the 3 main markets in US for any investors, if you follow where the funds are moving, where the institutional play is going, it's basically New York, LA, and San Francisco. Out of these 3, New York is the big apple is where most money is focused upon. People like your Anbang Insurance have bought Waldorf Hotel for almost about half a billion, 1.3 billion US dollars. So it's a key market. Why? Because it's an international global city. San Francisco have also seen increase in terms of values, mainly because support coming from Silicon Valley. LA is a large spread out city. It's very unlike Singapore. New York and San Francisco is a bit like Singapore, all quite condensed in that sense. Your New York prices have already seen prices hitting the last peak, which is in 2007. And a lot of the cities in the eastern side have already nearing the peak or have already crossed the peak. The western side is next to follow. You've got Singapore's Keppel Land, Pontiac Land, Singhai have already acquired residential development site in this area. And we think that the market is a little bit it's a seller's market currently, and we think that there's going to be still room for improvement. But for those who've bought property in US, my recommendation is start looking at taking profits. Why? Because your profit can come from the holding asset of the last 1-2 years. Capital gains might be about 15-20%. Every year you have actually gained about 10%. Plus there's appreciation in your currency of what you actually have held over the last 2 years. So there's a double benefit, so to speak. If you're looking at this is your seasonal house price index, and this basically shows that the market is actually coming up on a national level, almost close to your 2007 price peak. This is some of your changes on a year-to-year basis. US market in general has actually come up last 12 months, about 5.1% in rate, and in 2013 to 2014, about 7.4%. So the growth has slowed down. There's still a lot of people looking to buy. The biggest issue in a lot of these countries, like in Australia, let it be in US, and UK, is about affordability. There are a lot of people who want to buy affordable homes. But unfortunately, a lot of stock which is available are all the super luxurious portfolios, which becomes a dichotomy. So a lot of these portfolios are being brought into markets like ours, trying to lure investors to buy. But and a lot of these guys who are looking into buying might not be able to afford buying these portfolios, so they rent. As a result, it creates a huge rental market for these. New York has already exceeded the peak, as I mentioned. And this is LA prices almost hitting the peak of 2007. San Francisco is nearing that. Now, Australia has depreciated by about 22% in the last 2 years. If you look at Sydney and Melbourne, two very strong markets, strong demand coming from Australians, strong demand coming from Chinese buyers. A lot of Southeast Asian money has actually come into this market. People like residential. The Chinese like residential. Singaporean like hotels in this market. There is generally a shortage of residential. Why? Because speculative building is not available. Not like in Singapore, developers buy land, build speculatively. Over here, typically, there's less of those availability because the lack of financing given for speculative projects. The best market performance is Sydney, which has gone up by about almost 3-4% in the last, on a quarter-to-quarter basis, followed by Brisbane and Melbourne. Now, this is just to show where prices have been going. We've seen generally prices on annual growth have actually rebounded in February. It is starting to rebound. And if you look at Sydney, that's the key market right now. A lot of focus. Why? Because mainly there's a slight shortage or less overbuilding in Sydney compared to Melbourne. Melbourne, we're starting to see a little bit more supply in the marketplace. Rental markets is at the slowest pace growth-wise for Melbourne. Again, a cause of concern because you've got overbuilding, you've got your rental being affected. At the end of the day, you need to rent to get your yield in order to be able to furnish your loan. Now, UK is our key market. We are advising a lot of clients to take positions. Those who have bought property, they should look into taking profit. But that being said, rental is still very healthy right now, and we still think that there's uncertainty because of the elections that's coming in, depending on which Conservative or the Labour Party is going to win. Generally, your Sing dollar has remained fairly flat, if you're looking into here, depending on where you bought. If the last 2 years, then it has gone up by about 6%. If you bought it, let's say 12 months ago at 2.15, then it has depreciated in that sense. Economy strong. It's again a global city status. You are looking at generally a market which is being bought by the Middle Easterns, by the Asians, by Americans, by the Russians, and it goes on and on. Different markets, different timing. You have got different investors coming in into the marketplace. So whenever you've got a political uncertainty, for instance, in Russia, money will start to come into London as a safe haven. We think it is an equal balance right now for London. We think that it's a good time to take profit. But overall, London never see a crash in values. Even in global financial crisis, 5-10% dip, then you start to see investors coming back to support that market again. This is interesting. This is in our monthly report of Chrome, where you see prices of properties starting to, where we actually look at the different boroughs, and those that has got the highest price increase, which is 21-25%, which is in the dark brown, in Southwark, Newham, Waltham Forest have actually seen the highest jump in prices. So what has happened in the city centre, prices have actually moved up more than 20-30% in the last 2-3 years. Now the movement in terms of prices and demand have started to move outside your city centre, outside Zone 1 into Zone 2 and Zone 3. And that's why, because prices are more affordable for locals to buy. Same thing, average prices have actually gone up by about 12%. If you look at just central London, is where the big action is, 12-9%. But the rest of UK is very dull. There's not much activity. This is some of the asking rentals and some of the rental types that we have, all in our reports that we have by Chesterton. Housing tenure, which is mainly more than 50% owner-occupied, and some are without mortgages. Now, if you look at our main key theme for this market in terms of putting your money, our first area of of concentration will be basically UK. There's still a uncertainty because of the elections. But I think it is a market which is full of liquidity. Market is fairly toppish right now. A lot depends on the elections, who wins, what kind of policies that comes into the marketplace. The next destination that we think could be quite interesting would be Tokyo. Why? Because of Abenomics. Why? Because you've got a high spread between your yield as well as your cost of funds. One of the few places where you have a positive arbitrage in that sense. Problem would be, of course, your cultural difference. Language is a major issue. Mitsubishi Estates came here to launch Shinjuku property, sold out in Singapore, offering only 6% down payment, and the rest you pay upon completion. Very attractive for investors in a Shinjuku location. So a lot of investors partake, thinking that maybe about 2-3 years' time, nothing to lose, 6%, then you don't have to activate your loan, and then hopefully there could be some capital appreciation moving upwards. Keep an eye on Japan, whether it goes into recession, because the Abenomics meant to have Japan moving upwards in terms of inflation, 1-2%. Sydney and Melbourne is probably next on our end. Why? Because low build-up in terms of supply, fairly strong demand from Asian investors in particular, strong rental still, and also it's fairly near to Singapore. Now, I just need another 2-3 minutes to complete my slides here. Things to look out for 2015-2016 would be, keep a lookout on GDP performance. You need to know what's happening in the macroeconomics. Then you can predict roughly what's going to happen in terms of policies, tightening, which affects foreign investors. Then you can actually predict where interest rates are holding, and currency movements as well. Look at gateway cities. A lot of these have got the same phenomenon. Not enough affordable homes, too many luxury homes being built. Landed housing is almost always a preferred housing option. It can be in US, it can be in Australia, it can be even in Malaysia. Despite oversupply, landed properties are always in hot demand by locals in that sense. So you want to buy a market where there's a lot of liquidity, provided not by foreign buyers, but by local demand. That's your sustainable demand. Governments worldwide will have to trim budgets. Indonesia will have to trim their budgets, their deficit. One of the easiest ways is to tax foreigners who are buying property, and there's an additional income from them. Gateway cities will continue to see spiraling prices. Secondary and cities and suburban areas will see spillover positive benefits. Just like in London, it's gone up last 2-3 years. City centre is now not so affordable, but now all your Canary Wharf, your Royal Wharf have started to has become more affordable for locals to buy. In the past, locals don't want to buy in this location in Royal Wharf, but because of pricing, affordability has now started to change the picture. Differentiate between core markets, emerging markets, and new frontier markets. Core markets, a lot of information available. You know, like London, you look into Singapore, you look into Japan, Tokyo, New York, lots of information available. Once you go into emerging markets, a little bit sparse in terms of data points as to supply-demand component. Then you go into new frontier markets, you go into like Cambodia, you go into Laos. It's a bit harder to get information, is more like gold dust. So more risks, but at the same time, higher returns if you get it right. Pay attention on rental and the yield. Look beyond your rental guarantee, how much you can rent the property. If you get the property available now, how much you can rent. Can you get the kind of yield that the developer is actually promising you in terms of rental returns? Things to look out for the investment tips. At the end of the day, in a market where generally most property markets in the world are toppish, I think the strategy should be looking into wealth preservation rather than quick capital gains. Because I think wealth preservation is important to make sure that your money, you don't lose money, your property value remain as it is, and it might go up due to inflationary effect. Your currency, don't lose money as well, in terms of when the time you buy and the time you sell. So keep a lookout on these two parameters. Diversification of traditional key investment market. Look beyond, like for instance, London. Money is now starting to spread into Manchester, for instance, Birmingham, into Bath. Beyond New York, money is now starting to go into Miami, into San Jose, into Boston, Atlanta, and look beyond Sydney and Melbourne, because the next market we think will probably start to ride the upside is Brisbane. Diversification out from your traditional office, retail, residential. This is in particular for the institutional asset class. They are now looking into healthcare, hotels, and student accommodation, which is quite big in UK. Buy from developers with reputation. The Brazil Eco House was a bad experience. So make sure developers have got the ability to complete the project, and the quality is intact. Markets are at a peak. Don't be afraid to take profits and go back into the market when the market dips, in that sense. I like to end basically from a quote by Goodwin Gore from the Gore Group. Gore Capital is a renowned global private equity group. He says, I like to invest in markets with constraints where, oops, to the last slide. Right, thanks. What he said was, I like to invest in a market with constraint, places like London, Hong Kong, New York, where physical boundaries and planning policies create zones where people want to live or businesses need to be located. Now, what he's trying to say is that buy something where there is proper planning order, where there is scarcity, because you cannot just build another competing residential opposite just because yours is successful. So this is basically your core market, which is like in Singapore. It's regulated, supply limited, and people want to do business in that area. No possibility of someone building another alternative business park or competing financial district next door. So like Korea, there are about 4 or 5 financial districts, for instance. You don't want basically to do well in the development and someone rezone an agricultural land opposite, convert it into a township, convert it into residential, and compete with you in that sense. So which is why what Gore is trying to say is that go into market where there's a huge scarcity, go into markets where there's proper planning parameters, you know what is allowed in the whole area, and you can make informed decisions, so to speak. So with that, I thought maybe think about it. We look forward to some of your questions during the Q&A session. Thank you very much. Anyway, if you need any information, I've got my email over here. Feel free to communicate with me. Thanks.